Okay. All right, Matt, let's bring in our next guest. Philip Parker's with me now. Hi, Philip. How are you doing?
Hi, Ariel. Thanks for having me. Hi, Matt.
Good to have you with us today. A hugely busy day. You know, we were talking about this in the break. We've got so much going on out here. But, of course, what's really important to our market is what's going on in China. And we did see that PBOC rate cut coming through yesterday. And, as I said, we've just got 3 of the 4 major banks talking about lifting interest rates there. Should we be worried?
Yeah, I think we've been saying it for quite a while now. And, in fact, posted on our website in April and May some pretty sensitive data about what's going on in China. You look at things like concrete and cement construction falling majorly, 20% falls. You look at electricity output falling. So we find that there is a slowdown. We've been saying that when it was 9, we're saying it's going to be probably 7s in front of the GDP number. So we've taken a very active attitude towards that to reduce our risk. The other thing is that if you think that China represents exports of about 40% to Europe, and 25% to the US. So you've got 2 economies that are in sort of, well, you know, the Europe's are going to be at recession for a long while, maybe worse. And you've got America, which, had it not been for a lower dollar and them exporting their way out over the last 18 months, they'd probably been as dire a situation as Europe. So, you know, we take the view that things are slowing down in China, and therefore we're actively moving on our hedge positions and reducing our exposures over the last couple of weeks.
Yeah, you say that you believe we'll see a pullback on the ASX 200 sub 3,900 in the next month or so.
That's right.
Just how sub 3,900, and you talk about changing your investment strategy. Whereabouts are you putting the money?
So basically we see a sort of a 3,800 level as being support. About 18 months ago, we took the view that things were looking pretty crook, to use an Aussie vernacular, everywhere around the world. We sold half our equity portfolio and then we hedged the remaining equity portfolio using options. And that led us to outperform the index by about 16% for the year to December. What we do is, at this stage, we've kept our hedges up. We had a tough April in that run where we underperformed by a few percent for the month, but this month we're outperforming majorly, you know, in May and now this month with the falls coming through. What else do? We use gold as a hedge for when the central bankers are talking about, you know, printing more money. We've been in and out of a gold ETF, and we've also used a US dollar. We were long, a short Aussie, long US at 105. We've covered that the other day at 97 for a very nice profit. So, yeah.
Okay, so what does your portfolio look like now? I mean, what portion of your portfolio is in equities?
Yeah, so just under 50%.
So you're still pretty overweight.
Well, there's 50% cash, but the 50% we hardly carry any.
Sorry, 50% cash?
Yeah, 50% cash, 50% equity.
What are you waiting for that catalyst to send you back into the market? I mean, what are you doing in cash in these
Well,
markets?
we think that when you get the full results out of what's going on with the banks in Spain, then you look further down the track to banks in France. Now, I was a banking analyst by training, so I've actually looked at the balance sheets. I think there's going to be some major shakeouts in Europe. That's going to affect, you know, a whole lot of funding. We're out of the banks. We sold the banks 18 months ago. You know, we're way ahead on our position, even if you've had in dividends. We sold out of the big mining companies as well. But, you know, and we're way ahead. We're like 40% ahead by not being in those. Where we have kept our exposure, to answer your question, 50% equity is exposed to things like mining support, oil and gas companies that have got oil condensate cash flows where they're actually funding their developments from the cash, and we've done extremely well out of those investments. And we've also got a, you know, interesting stock, IPP, which is a property portal, similar to realestate.com and domain.com here in Australia, but run by Aussies, but in Malaysia, Singapore, Hong Kong and Indonesia. Huge growth, basically, you know, replicating the development model of Australia in those markets, which is underdeveloped. So great business. And other things like corporate travel, which has been a great investment for us, where we've doubled our money. So we're very stock specific. So if you like, we like to use value-based to find companies, but we're also macro-driven. And if we think things are looking risky, we'll get rid of the big liquid stocks quickly, cash up, and then hedge for the rest of the portfolio that we want to hold.
Yeah, that oil and gas stock that you were talking about is Aurora Oil and Gas, shale gas producer. Tell us a bit more about that one.
It's a great business. It's based in Texas. We've got to know the management really well. We've had 2 or 3 visits. So in fact, Tim Ridd, my other analyst with me, he goes over there in July to look at the wells. It's going to do about $500 million in revenue next year from oil condensate. It's basically got very cheap costs. It's running at about 10% cheaper cost profile than the Cooper Basin, which is a great area, don't get me wrong, and we've got some investments there. But, you know, great growth. You're actually, on 2013 earnings, we're buying it at 3 times enterprise value to EBITDA. So we think it's a great business. Marathon Oil has got a share of the business in there, and they're spending $1.5 billion a year in developing the projects, and they've got 6 frac crews, 5 frac crews on their sites. In Australia, we've got 4 or 5 frac crews completely. So yeah, sorry.
Philip, we are just out of time, but I was just looking at that chart, almost up 300%, 280 or so % over the last couple of years.
Yeah, we think it could go to $5, nearly $6 on the 2013 earnings profile.
Okay, all right, we'll be keeping
334.
Keeping a close eye on that.
Great business.
Okay, great to have you with us.
Thanks.
Philip,
Thanks for having me.
us.